For more insight, joining us from Melbourne, Florida, is Jeff Smalls, president at Arbor Financial. Jeff, how are you?
Great. How are you guys doing?
Good. So let's talk a little bit about the trade talk developments. It seems like a lot has happened just since Friday over the weekend. So in your view, what sectors are being affected the most, and how are markets kind of responding to it? We saw that futures were selling off pretty harshly Sunday night, but that things look okay right now with things in the green.
Yeah, it's good to see things in the green right now. I think that the greatest risk for investors going forward in terms of portfolio allocation is going to be in the energy sector. That has the largest share of risk with a global slowdown and as the U.S.-China trade war escalates. We really need to see a de-escalation in the China trade war. And then the second most element of risk, I think, is in the tech side of the equation. Tech is really overexposed. It's had a really good run, but that can also be affected by trade. But I think that this could also present a buying opportunity as we see the markets are starting to buoying back up. And the tech side of the equation, there's still some perennials. The FANG stocks are really kind of on sale right now compared to where they were over the last few weeks.
It's Julia here. I want to talk about the U.S. consumers, what's really driving the U.S. economy right now. That consumer sentiment has remained strong. We still have low unemployment. So where do you see that going, and can that turn, and what do you think would make that turn?
Well, there's lots of things that would make it turn, but so far it hasn't turned. And that is the strongest part of our economy right now is the consumers being at full employment, wage increases, equal people spend more money, rates are dropping. We're going to see consumerism even expand any more as rates go back. As far as it turning, unless we go into recession and we see massive layoffs, I don't think it's going to matter until we start seeing companies pull back due to the China trade war. And I don't see that happening either. Companies aren't going to pull back. There is some political risk going into next year's election term. We might see CapEx spending start to stop or drop as companies might get prepared for more regulations going forward on the environment, on taxes, et cetera, et cetera. The biggest mistake that we could see going forward that would really hurt corporate America and employment, though, would be if we raised corporate taxes. Leveling the playing field to 20% was one of the greatest political gains and economic gains we've had, and no politician's been able to do that since the last 50 years.
Jeff, it's Dan here. We're talking about the positive indicators about the U.S. consumer and consumer confidence, and yet there is a concern that if we sort of talk up the possibility, or I guess at this point the consensus appears to be likelihood, of a recession, I think some people worry that we can kind of talk ourselves into it. I've been asking all our guests about this. Do you think there is a concern right now or a danger of making the recession happen because of headlines and sort of scaring people into that?
It's really crazy what the media does now. They've taken this sensationalistic approach, or almost a national acquire approach, and they make things reality when they really aren't. We are nowhere near a recession. We have the greatest employment story that's never been told in the last 50 years. And I think what the problem is, we're at the end of the longest economic expansion, and we know economics are cyclical. We know we're late stage bull market with what's happening. We know the global banks are going to zero for a reason. And every time the Fed has followed rates, or rates have dropped, and then the Fed has lowered rates in an economy that was expanding with positive GDP, we have seen the economy fall off and sometimes even tank. And so the writing's on the wall. We're going to have a slowdown. It's not going to be like 2008, 2009. We're probably a minimum of 18 months away from a slowdown. But it's going to be very hard for us to see GDP go sub-zero for 2 consecutive quarters. We're going to be in that area. But there's a conflict going on inside of the economy right now.
All right. Well, plenty of noise for the markets to sort through. Jeff Small, Arbor Financial, thanks so much for joining us today.
Thank you.